Hey Bowtie Nation, Joseph Hogue here with a 7-step roadmap to living off your dividends, or more like the 7 stages to get there. That's because, Nation, I've been investing for over 25 years now and have gotten to that point where my dividend stocks pay the bills, but it was not easy. In fact, there was more than a few times when I just wanted to quit investing altogether. But I did learn a thing or two, not just in more than a decade as a professional analyst, but more from the mistakes I made in my own portfolio. That's what I want to share with you now, so you're living off your dividends in less than half that time. And when you begin that journey, that first stage is the same for so many people. I know it was when I began, so long ago, sitting in the library at the Marine Corps Recruit Depot, Paris Island, opening my first investing account. I felt like I would never get out of that paycheck-to-paycheck nightmare. I know a lot of you feel like that, trapped in that never-ending cycle, just one blown tire from falling behind. Then you see videos about people living off their dividends, those giant high-yield stocks that make it look as easy as finding sand at the beach. And that is where too many investors doom themselves, chasing after those high-yield dividend stocks. Now don't get me wrong, there is a place for these in your portfolio, but these high-income and even dividend stocks in general will never get you to where you need to be. Now that might sound confusing in a dividend investing video, but you need growth stocks to grow your portfolio to the point where you can live off your dividends. Think about it this way. Even on a high yield of 10%, which is about as high a dividend as you can get safely from any stock, that is still only about $10,000 a year in dividends on a $100,000 portfolio. Now that's not bad, but you're still not living off of it. At a 10% dividend and trying to cover $50,000 in living expenses, you need a $500,000 portfolio. So to get you to that point, that $500,000 or more portfolio, we need growth stocks first, and that brings us to our first stock, Zscaler Corporation, ticker ZS. Now Zscaler changed legacy cybersecurity from a network and firewall architecture to a zero-trust model in the cloud, and that first mover disruption accounts for its amazing revenue growth. Sales grew by 54% annualized rate in the 3 years through 2023. It now serves 40% of the companies in the Fortune 500 list and is a market leader across business groups. Shares did come down on a disappointing outlook in the last quarter, but the company recently announced a partnership with CrowdStrike that could solidify its leadership and the growth along with it. The two are launching a new set of AI and zero-trust integrations into CrowdStrike's Falcon software to coordinate threat sharing, detection, and response. Zscaler's Zero Trust Exchange and CrowdStrike's Falcon software are each company's competitive advantage in the industry, and combining them together, I don't think there's another company that can beat that. I've been aggressively buying Zscaler and CrowdStrike in my own portfolio, and cybersecurity is my favorite growth theme over the next decade. So for those of you just starting out or focusing on that portfolio growth, this is where it's at. Now, of course, this doesn't mean put all of your money in Zscaler or any of the 7 stocks I'll use as examples today. Instead, at each stage in your path to living off your dividends, try focusing on those types of stocks. For example, if you're starting out, then focus on growth stocks that we talk about here on the channel that are going to grow your portfolio faster, along with maybe a few stocks in the next 2 stages. It doesn't take long to get to that second stage, feeling overwhelmed with investing. You're spending hours a week, sometimes hours a day, trying to find those stocks, and it all sounds like a foreign language. The easy answer becomes do what everyone else is doing, so you rush out to buy the most popular high dividend ETF, like maybe the NASDAQ 100 Covered Call ETF, the QYLD, with its 11.6% dividend. And just like with those individual stocks, the high yield stocks, the dividends look great for a while, but the constant crush of seeing that stock price fall or go nowhere is just demoralizing, especially when it seems everyone else is getting rich. The QYLD may be churning out that 11% dividend, but the price is up just 5.5% over the last year, while the NASDAQ index is up over 34%, and it's even worse longer term. Over the last 2 years, the QYLD is up just 9.5% versus a 70% jump in the NASDAQ. You would have given up over 30% annual return for less than half that in dividends and price. A great alternative, though, can be in shares of Diamondback Energy, ticker FANG, with its 4.6% dividend yield. I highlighted Diamondback recently as one of my favorite stocks that beat inflation, increasing the dividend payment by 700% in the last 5 years. Now, it's unlikely to do that over the next 5, but with FANG, you get a strong and growing dividend yield to give you that cash flow motivation, but also a stock that's going to help grow your portfolio. Diamondback and other energy stocks have banked on record U.S. oil production over the last 5 years, and no other area has benefited as much from the Permian Basin, where the company has its assets. Despite a slowing economy, dual conflicts in Ukraine and Israel have kept oil prices higher, and that's contributing to those higher earnings. Diamondback expects to turn just 3% growth in oil production into a big earnings jump and a 7% increase in the base dividend. Analysts expect revenue to grow at 20 and 40% this year and next, so you're going to continue to see that dividend grow as well as the stock price return to motivate you to keep investing. We're just getting started on your dividend journey, but I also want to personally invite you to get the weekly bow tie, our free weekly newsletter with all the stock market news, strategies, and trends you need to see. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. Now, if you hadn't been investing in growth, instead chasing those high yield stocks leads to stage number 3, the struggle. This is where you realize that your account value is going nowhere with those high income stocks. You love seeing the dividends, but it is so discouraging feeling like you're getting nowhere fast and certainly not getting to that portfolio big enough where your dividends are going to pay the bills. It's here that investors just start slowing down how much they invest. After all, if your dividends are only paying for that occasional cup of coffee, hell, you could just do that yourself without investing. But for this stage, this next stock recommendation could surprise those of you in the nation, the Fidelity High Dividend ETF, ticker FDVV. And well, maybe it's a little surprising because I've come down against the FDV in the past. Well, because it's not really a high dividend ETF. If you look at the stocks actually held in the fund, see it's actually a growth stock ETF. Apple pays a measly 0.4% dividend, less than 0.5% there, but even that is a cash machine compared to Nvidia, which just started paying out its ginormous penny per share for a 0.03% dividend yield, which I guess you could call that a dividend if you squint really hard and have very low expectations. Even Microsoft, the cash king of big tech, pays a dividend of less than 1% yield. So with that measly 2.8% dividend yield, it's not exactly what I would call a high dividend ETF, but it may be perfect for your needs because with that growth stock focus, the fund has returned almost 30% in the past year along with that cash payout. So here, if you still want to get that motivation from seeing that dividend cash flow come in, but you know you need to keep that focus on portfolio growth, this is a great balance between the two. Stage 4, though, is the crash, and it hits every investor. The only difference is how you react to it. And at this point, a stock market crash is at the worst possible moment. If you followed that normal path of high-yield stocks, you're already wondering if that portfolio is ever going to amount to anything, much less enough to live off your dividends. And now a market crash just finishes the job. Historically, the market sees a correction, a loss of 10% every year, and sometimes multiple corrections a year, like in 2022, when the market pulled back 4 separate times. Crashes are less frequent, only about 5 years, but are more painful at a loss of 20% or more. In fact, the average market crash has wiped out 32% off the value of stocks and lasts around a year from the peak in prices to the bottom. This is the point where a lot of investors just give up, and it's too bad because if you can make it through your first crash, keep investing, even in the worst of times. Nation, it may be cliche, but it's true that it's always darkest before the dawn, and after a crash is going to be some of your brightest days in the market. To be ready for all of this, we want to add some diversification in your portfolio with a fund like the Real Estate Sector Spider, ticker XLRE, and its 3% dividend. Again, the dividend really isn't the focus here, though it will keep that cash flowing. What's important here is twofold. First, just having that money in a different asset class, so investing in companies holding real estate rather than an all-stock portfolio, it's going to smooth things out when a crash or a correction comes. Second, though, with the Fed now starting to lower its interest rates, that's going to support real estate prices for some upside growth, which we already see in a 20% return over the past year. The XLRE is an ETF holding 31 real estate investment trusts in the S&P 500 index, so the largest real estate companies in the United States, like American Tower, Realty Income, and Digital Realty, spread across property types and geographic regions. No other sector got hit as hard on those high interest rates as real estate, with the group up just 4% over the past 5 years, trailing every other sector in stocks. But in that, you find your opportunity because investors forget after that 2008 crash, real estate was one of the best investments in 5 of the next 6 years. There is no better inflation hedge than real estate, and as interest rates come down over the next few years, these real estate stocks could produce strong returns on top of that dividend yield. We've got the best 3 stages left where you do start seeing that you can really live off your dividends. But first, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Stage 5 in your dividend journey is my favorite because when that market rebounds and takes your portfolio with it, it feels like you're new again. Seeing your stocks take off just energizes you, and for the first time since starting investing, you start to feel like living off your dividends might be within reach. But it's here that you want to keep that focus on growth for just a little longer, getting your portfolio to that payoff with growth stocks like Palantir Technologies, ticker PLTR, up 257% so far this year. This company is leading in that AI transformation theme, leading in data management and analysis. Palantir is a lock for AI and data analysis in the government space, but is also growing its dominance in the commercial sector with 55% sales growth over the last year. So growth in that enterprise space is what's driving it here, with 24% revenue growth this year and 20% next to $3.3 billion. Just as impressive though, the company is expected to nearly double its earnings over the 2-year period. But like the lady said, isn't it ironic? Because just as you're feeling good about your investments, that proverbial tire does blow and you get hit with an unexpected expense that sets you back. Now the good news is that because it's happening now, instead of before you started investing, it doesn't push you into that downward spiral of bankruptcy like it might have once. And because it's happening now after you've seen that power of sticking with your investments, instead of defeating you, it makes you want to fight harder. You determine to sacrifice to pay the bills without taking money out of your portfolio and keep pushing forward to that goal. And one of my favorite stocks right now will help you do that. Ally Financial, ticker ALLY, an undervalued dividend stock up 28% in the past year. I highlighted Ally recently as the only dividend stock I was adding to my portfolio for its yield plus growth potential. Shares of the digital bank plunged 17% on its last earnings call, despite beating earnings forecast by 79%. In fact, the company has been progressively beating earnings expectations over the past 3 quarters. Now, what Wall Street didn't like, though, was the weakening in consumer loans, especially the auto loan segment. Auto loan charge-offs, the percentage of loans the company believes it will not be paid back on, are now expected as high as 2.3% versus a previous estimate of 2.1%. And Ally put another $645 million into its loan provisions. That's a cash account used to offset bad loans. Total auto lending at $9.4 billion also came in about $1 billion short of estimates, as the company tightened its loan standards to avoid more defaults. So management was clearly signaling a storm here and that it's hunkered down for the next few quarters. But Ally is a solid fintech, and while auto lending is still its bread and butter, it's also the largest digital bank with growing businesses in insurance, credit cards, and home loans. Now, all you out there in the nation know SoFi Technologies is my go-to fintech with over 25,000 shares and a $100,000 profit, but the 43% surge in the stock has made it pricey at over 2 times on a price-to-book valuation. Shares of Ally, though, are trading for just 0.85 times book value after that drop, a ridiculously cheap valuation for the growth it should see when lending rebounds. And if that wasn't enough, the bank has a vote of confidence from the Oracle himself, Warren Buffett. Buffett's Berkshire Hathaway portfolio owns 29 million shares of Ally, and while it's not a big part of the overall portfolio, it does give him 9.5% of all outstanding Ally shares. But nation, then you reach stage 7, the payoff. You get to where your portfolio can start paying off the bills, or at least a big chunk of them. This realization starts slowly when you notice that even on a 4 to 6% dividend yield, your portfolio would start paying progressively higher bills. Maybe it starts when you reach a $30,000 portfolio and you realize that a 5% dividend would make you about $1,500 a year, enough to pay off your car insurance each month. Then when you get to $100,000 and your dividends could start making your car payment or your health insurance completely. And here, finally, you're ready to start reaping your rewards, shifting your portfolio into those dividend stocks and the dividend ETFs and living off those dividends. And there are few better investments to help you do that than the JP Morgan Equity Income ETF, ticker JEPQ, with its 9.5% dividend yield. This is similar to the QYLD with that focus on the NASDAQ 100 index, but with the expertise of JP Morgan managers. This one has produced a 14% return over the last year. That is rare for a high-yield dividend fund to produce a double-digit price return as well, so this one should help you pay the bills living off your dividends, but not see your portfolio value shrink. Stay up to date with all the stock market news, trends, and strategies you need with the weekly bow tie, free with the invite link below. Or click on the video to the right for the 12-stock dividend portfolio that will put cash in your pocket every single week. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.